Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by a special guest, Stephen Haskell, Vice President of 1031 Exchange Sales at RealtyMogul. With a deep-rooted expertise in investment and real estate, Steve is here to shed light on the intricacies of 1031 exchanges and other key topics in the personal investment landscape. Steve's impressive career includes a role as a Senior Vice President at a top investment firm where he worked closely with clients navigating 1031 exchanges and direct investments. He also led the San Diego office at Key Property Investment, establishing himself as an authority on Delaware Statutory Trusts, DSTs, and passive real estate investments. His strategic insights have helped facilitate hundreds of millions of dollars in real estate investments through various private securities. In addition to his financial expertise, Steve brings a unique perspective from his 14 years of service as an officer in the United States Air Force. Stephen, welcome to the show.
Thanks, Marc. It's a pleasure to be here.
So I'm looking forward to today's topic. I think, real estate in general, but also 1031s, DSTs. It's one of those topics in real estate that even real estate investors hear of, but they're not really sure how to use them, what they are. So, I think it'll help to shed some light and if we can go into some details on some of those. But maybe even let's just start off with what is a 1031 exchange? Why is it beneficial? And, how does someone use it?
Sure. So the 1031 has been around for nearly 100 years. And every couple of years, though, it gets threatened a little bit, right, by the new administration that comes in, and our industry gets a little unsettled. But the thing is that 1031, which I'll get into in a minute, is so integrated and so important to our economy that getting rid of it would be so devastating to the economy as a whole that we're pretty sure that it's going to stick around and it's here to stay. Usually when the administration turns over, there's a little bit of a threat, the signals that go out. I think in the Biden administration's blue book, they put out that they wanted to limit or get rid of the 1031. However, as we thought, it is going to be here to stay. And basically all the research that goes into it says that it's not going anywhere because it'd be too devastating for our economy. And I'll tell you why. The 1031 exchange allows real estate investors that own non-owner occupied units, so real estate held for business or investment purposes, to sell their real estate. And then if they reinvest in another, what we call like-kind property, then they can defer their taxes. So a like-kind property merely means a property held for business or investment purposes. So it can't be your home that you live in, or it can't be a vacation home or something like that, but it can be raw land. It could be your Airbnb. It could be a medical building. It can be a hotel, multifamily complex. And so investors, they sell their property, 1031 exchange into another property, and they help defer taxes such as state and federal capital gains, state and federal income tax, one that not many people think of, which is depreciation recapture tax, which could be up to 25% of their depreciation, and also the Medicare tax and any other potential local taxes that are involved, which could be up to 30 to 40% of the sales price of their real estate. By utilizing the 1031 exchange, they're able to preserve their capital and really preserve their family wealth, because real estate is typically constitutes a big proportion of our clients' family wealth, right, is in that real estate. So not having to take a huge 30 to 40% loss to Uncle Sam is really important. So that's why the 1031 exchange is so valuable, especially lately.
Yeah, I think that you mentioned the depreciation recapture tax. I think that one, people kind of don't realize it or forget about what that is, because let's just say like you buy your property for $1 million and you think you're going to sell it for $2 million. You say, okay, I have $1 million in capital gains. But the reality is, depending upon how long you had it, you probably depreciated it over whatever, period of time you had it. And you're going to wind up owing more then because what depreciation is doing is basically lowering your cost basis every year, and you'll wind up, owing more than what you thought was the capital gain. So I think that's definitely a big benefit of it as well.
Right. I mean, once you add up the tax consequences when you sell a piece of real estate, especially one that you've actively managed, it almost takes all of the upside out of it because its taxes are so severe. And then just the price of buying and selling real estate. So the 1031 exchange is definitely a major advantage for real estate investors as they look to either get out of active management or diversify their real estate holdings, or what we're seeing lately is get out of California, especially, or New York and places like that, and try to enter into more landlord-friendly states.
Oftentimes, when I hear people that are thinking of doing a 1031, they kind of say, "Oh, it's too complex and it's not worth it," and they kind of throw up their hands and say, "I'm not going to do it." Can you walk us through and kind of what's the life cycle of, or how does a 1031? What's involved in it, and is it really as complex as some people make it out to be?
It can be overwhelming and stressful. That's why I typically recommend to my clients that we start getting educated, preparing, and doing our due diligence months ahead of even listing the property. When you sell a piece of property held for business or real estate purposes, from that day you close escrow, you have 45 days to identify a replacement property. And there's certain rules that you have to abide by that the IRS requires you to use when you identify the replacement property. Now, concurrent with that 45-day timeline, you have a 180-day timeline, which is the time that you're allowed to close on the property that you identified. So you close on the property that you sell, you have 45 days to identify, and then you have about 135 days after that to close on that property. So that 45 days gets really, really tight and a little stressful if you don't prepare ahead of time, especially because you have to think you have due diligence that you have to do. A lot of people, you want to walk the property, third-party reports and things like that. And if you fall out of escrow, well, you're kind of out of luck, right? Because then you're going to have a tax consequence because the property you identified didn't work out. Now, there's ways that we get around this with the certain rules and the ways that we hedge against that closing risk that maybe we can talk about later. But before we do, there's a couple other rules that we also have to be aware of. First, you have to purchase property of equal or greater value. So if you sell for $1 million, you have to purchase a property for $1 million. The second rule that you have to use is that you have to use all of the cash proceeds from your 1031 exchange. So when you sell a piece of property, you're going to have some cash that goes into what's called a qualified intermediary account. A qualified intermediary is simply a third party that holds on to the cash for you. So you're not allowed to touch the money. And so when the property sells, the escrow is going to send that money not to your bank account, but to a qualified intermediary that holds onto that money and releases it to the seller of your replacement property. They're also called accommodators or facilitators. All of that money, you're not allowed to take any money out. If you touch it, you pay taxes called boot on that money. So just to sum it up, you must purchase property of equal or greater value. You must use a qualified intermediary, so don't touch the money. And you must reinvest all of the proceeds that are in your qualified intermediary account.
And what if there's debt on the property that I'm selling? So so again, use that example. Let's say it's $1 million property, but I have 500,000 of it is debt. When I identify my replacement property, when I 1031 my replacement property, how does the debt impact that property value and the debt that I'm using on my replacement property?
Usually people have to replace the debt. That's just the common rule that they use. However, really the main goal and the real true rule that the IRS looks at is purchasing property of equal or greater value. So if you sell property for $1 million and there's $500,000 of debt, escrow will pay off the loan, send the other $500,000 of cash equity to the QI, qualified intermediary. Now you have $500,000 of cash to buy $1 million worth of property. So usually people go and take out a loan to do so. However, you can add cash if you want. Or maybe you add $250,000 of cash, then take out a loan of $250,000 in order to achieve that $1 million. Either way, when the folks that I see that have been audited on their 1031, I'm not a CPA, so I can't give tax advice, but I can just kind of give you general experience that I've had. The IRS has looked at, hey, did you purchase property of equal or greater value? Did you use all the cash in your QI account and not take any out? Did you meet your timelines? And then finally, one thing that I haven't mentioned yet is holding title the same way. So if you sold using your LLC, you need to buy replacement property using that same LLC. Or your family trust, right? If you sell using your family trust, then you need to buy the replacement property using your family trust.
That one, the titling, a lot of people have questions with that. They may have this investment property that they personally own, or whether it's an LLC or whether it's themselves, but they 100% own it. And they just say, you know what, I'm kind of tired of managing a property, and I know that you can have property managers and all that, but they say, oh, I want to 1031 this into some kind of group project or, sponsored project. And they're often not aware that, okay, the titling has to be like titled also. For you to do that. Is there any ways that they can get around that and go from something that they own 100% into, maybe something where they're a limited partner on?
We often use limited partners or partnerships or LLCs or REITs as a way to explain the different structures of ways to hold title to real estate in a fractional ownership model, which is becoming very, very popular. But the only fractional ownership model that has been approved by the IRS in an actual ruling is the Delaware Statutory Trust, which was approved in IRS ruling 2004-86. And so what that allows investors to do is to sell their property, then 1031 exchange into a piece of another property. So they actually own a piece of that Delaware Statutory Trust that holds title to the real estate. At RealtyMogul, my company, what we do is we have 1031 solutions for people, and Delaware Statutory Trust is one of those. So our clients sell their property. They'll maybe sell for $1 million, and they'll take $250,000 of that, for example, and buy a piece of a Walmart in Texas. Then another $250,000 and buy a piece of a multifamily building in Raleigh. Then another $250,000 and buy a piece of a self-storage unit in Nashville, Tennessee. Then finally another $250,000, they'll buy a medical building in Washington. We diversify them by geography, by asset type, asset class, and then also management, right? These are turnkey solutions. You can close on them in just 3 to 5 business days. They're already bought, stabilized, management is in place, third-party reports are in place. And then it's a nice, smooth, turnkey 1031 exchange. And that's why the Delaware Statutory Trust has become so popular over the last decade or so.
How does it work in terms of the Walmart or that self-storage? Is that like an established entity? And then in terms of the fractional ownership that they're buying, who are they buying it from? Is it the sponsor, or because a lot of times you see like when, okay, we're going to raise capital for a project we're doing and we have this cap table and here's what it is and everyone can see what it is. And now the project starts. But here it looks like the project has started because not everyone's 1031ing at the same time into so how does the ownership and the shares work in that sense?
Yeah, great question. So we also have another 1031 vehicle called a tenants in common. And that's much similar, operates much like what you just explained. So we have over 100 different sponsors that we work with that are raising capital with tenants in common, usually 1031 capital. They line up the capital and then they buy the property all at once. And so there's closing risk there, which can be a little unnerving for some investors if they're in a 1031 exchange. And if for some reason the sponsor can't close on the asset, well, then that could lead to failure in the exchange if they don't have a backup option. which, if you want, we could talk about later. But in a DST, it operates differently. In a DST, Delaware Statutory Trust, the sponsor, which is the company that buys and manages the property on behalf of the investors, they go out and they actually buy the property, and the DST is on title for that real estate. So if you look up that piece of real estate in public record, you're going to see ABC Delaware Statutory Trust as the owner. That real estate is typically stabilized and cash flowing, and the money's flowing up through the property, through the lease, and into the bank account of the sponsor. Then as 1031 exchangers come in, they're buying up pieces of the trust. It only takes about 3 to 5 business days, usually on average, to close on that trust. And then the sponsor revenue starts generating immediately, and the sponsor will start peeling off revenue in pro rata share and putting it into the bank account of the investors as they start to buy out the Delaware Statutory Trust. And once they reach a certain amount, basically the price of the property and the trust, once they raise that much capital, the capital raise is done, and they can't raise any more capital, and they can't ask for any more capital in the future. Those investors now own their pro rata share of that real estate, and they get their pro rata share of the net operating income and the pro rata share of any potential appreciation on the property on the back end.
Does the share price that the investors are purchasing it for, does that change over time? So let's say that this trust purchases the property for, let's just use $1 million, and a year later, a 1031 investor comes in, and maybe now that property is worth $2 million. Are they buying at the $2 million valuation, or are they still buying at the $1 million valuation?
Unlike a lot of funds that you might see where they have different valuations throughout the year and people could come in at different rates, which we also have on the RealtyMogul platform, the DST is a fixed close-ended fund or a close-ended entity. So the price is fixed, and whether you come in at the beginning of the capital raise or at the end of the capital raise, you are paying the same amount, and you get the same amount of real estate based on the amount of cash or capital that you invest in that DST. So it doesn't matter when you invest into that property.
And what's the life? Those like the typical life cycle? Are there DSTs that go on in perpetuity, like forever, or is there always like this is gonna be sold in 5 years or 10 years or some specific time, or is it this may be sold at a certain period of time?
Right. So on average, a DST has been held for about 5 to 7 years. We've also had a wonderful real estate market over the last 10, 15 years. So going forward, it might be a little bit longer, or you might have some that go less. Usually their target is about 5 to 7 years. The sponsor usually is trying to hit that range. But if the market shifts, then they may hold it longer. If you have an unsolicited buyer that comes along and offers a great price for the property, they may sell it before their targeted disposition timeline. However, part of the reason that you'll see DSTs sell between 5 to 7 years is because of the debt that's built into the DST. The DST debt usually has a loan that balloons at year 10. And there's often prepayment penalties in the first few years. So you have a sweet spot that's typically between 5 to 7 years in which you have a nice real estate cycle that's gone through, has given the property time to appreciate, and they can exit the property before they come up to that balloon loan. Now, here's something else that's interesting about DSTs is that you're not allowed to refinance. So that debt is what you get in a DST. Unlike tenants in common, which refinancing is usually a part of the strategy, or some other different types of entities that we use on our platform to invest in fractional ownership, DSTs are not allowed to refinance, which means that they got to sell that property before the loan balloons at year 10. So that's one of the reasons you'll find that in the window. That does introduce risk, but I also want to point out that financing is a huge benefit potentially for a lot of investors because they don't need to sign for the loan. They don't need to get underwritten by the bank or apply for it. They can simply invest in the DST, and it helps with that 1031 exchange requirement of purchasing property of equal or greater value. If you have a DST where half of it was bought with a loan, half of it was cash, that means it's 50% loan to value. If you put $100,000 into that DST, you're buying yourself $100,000 of equity, $100,000 of debt, and $200,000 worth of property, and it's turnkey. So for those that are having trouble finding a loan or are having a hard time finding a loan that makes sense and just can't complete their 1031 exchange, well, a DST is a nice turnkey option where they can get the debt that they need, even if they potentially have bad credit or so on. The only requirement personally is that you're an accredited investor, because these are private placements. And so all of the investors that invest in these types of assets have to be what we call accredited.
What are the options when let's say the property that the DST owns is sold?
When the DST is sold, the investor has the opportunity to either 1031 exchange into another Delaware Statutory Trust. They can 1031 exchange into their own property that they own outright. They can pay taxes, or they can do a combination of all three.
If I decide to pay taxes, am I paying taxes on whatever happened in that DS since I've owned that DST? Or does it go all the way back from every 1031 that I've done?
Yeah, good question. So it adds up. For all the real estate that you've ever owned, as long as you 1031 exchange, you can continue to defer your taxes. But as soon as you realize that sale and you liquidate and you don't 1031 exchange, then all that depreciation recapture, all that capital gains, you're going to be obligated to pay it at that time.
I want to take a little bit of a turn to talk about the due diligence of how someone looks at whether it's something on your site, RealtyMogul, or just DST in general. Because that's, I think, a lot of the fear a lot of times of investors is, it's kind of this black box. I don't know what's going on inside the investment. They might be in Bermuda somewhere. How does RealtyMogul approach the due diligence of whether these DSTs are allowed on your platform or not? Or how should someone decide whether, I want to invest in this one, or no, neither of these make sense? Because if you look at on paper a lot, they all look good. All the numbers always look good. But then there's, some turn out great and some don't turn out as great as the numbers look.
Right. Well, I want to start off by saying that this is real estate, and the Delaware Statutory Trust does not shelter the asset from economic conditions. We like to lead with the risk at RealtyMogul. If you're a client or exchanger or a real estate investor, you're going to come talk to me or someone from my team, we're going to try to point out all the ways where you could potentially lose money. And that's one of our jobs at RealtyMogul with our broker, RM Securities, whose job it is to review the business plan, to review the background, do background checks on all the leadership of the different players within the sponsor group. They're going to look through all the third-party reports. So the appraisals, engineering reports, the estoppels, the lease audits, the environmental surveys. All those are already done, completed, and reviewed by our analysts. And they're actually available for review from our investors upon request. Our analysts also make notes and we write questions. And before we accept the DST, we will write questions over to the sponsor to have them respond to make sure that all of our concerns are satisfied. If they're not, then we reject the property. If they are, then we accept it. Now, one of the reasons I moved to RealtyMogul was because at RealtyMogul, they don't just check the boxes with their due diligence, which I've seen a lot in this industry. You're seeing, hey, as long as we check these boxes, it's going to mitigate our risk of any kind of legal recourse or things like that. And so it just becomes a really fast and expedited box checking type process. But at RealtyMogul, the way that we do due diligence is our investment committee, and Jillian, really our CEO, really looks at each deal and says, would I put my money into this property? So they look at comps, but not just comps. We look at, hey, are we going to overcome the fees? We look at the costs that are in the DST and say, hey, everything checks out. This all makes sense. But when you look at the submarket, do we think that there's enough growth where the cap rates will compress enough to overcome the fees on the front end. And even if everything else checks out, if our CEO or our analysts don't feel comfortable and think that they would be able to get their money back, then they're going to not allow it on our platform. It can be a little frustrating for me as a sales guy, and my team having less product than maybe some of our competitors, but we sleep well at night because of that. And I can't guarantee that they will all work out. But at least when our clients come to us, we will comb through the due diligence, the third-party reports. So our investors are going in to the properties with eyes wide open and with hopefully months of education that we get explaining to them how these deals are put together. What are the pros and cons of the different entities we use, whether it's a TIC, whether it's a DST or triple net lease assets that we sell on our platform. And so we help pair them with the right entity. We tell them the different pros and cons of the different asset classes that we have on our platform. And then we build customized portfolios for our clients so we can help diversify them and mitigate concentration risk, a potential volatility in the market by putting their money in high quality real estate in good markets and diversify them so all their eggs aren't in one basket. But even that being said, Mark, it's real estate. And sometimes things outperform and sometimes they don't.
Yeah, makes sense. One other, topic of this I wanted to bring up was, and a lot of people are hearing or have heard recently about qualified opportunity zones. And how do they fit into? Can someone 1031 into a qualified opportunity zone? And I know maybe you can just explain a little bit about, two questions I have on them, or a little bit about how, we've been talking about 1031s and DSTs and deferring taxes, but I think the qualified opportunity zone has an aspect of that, but also an aspect of you actually are eliminating some of the capital gains. And then also, are there still opportunities in qualified opportunity zones? Because I know there was a deadline at one point that you had to have your investment in by. Are investors still able to utilize qualified opportunity zones?
Yeah, so there's still opportunity there in qualified opportunity zone funds, but a lot of the benefits have already phased out. We'll see what happens in the near future to see if they extend any of those benefits. There used to be a step up in basis that you would get, so you'd be able to wipe out some of your tax consequence by investing in qualified opportunity zone funds. At this point, you only get a deferment. So your taxes are deferred until your tax return of 2026. And then if you hold your investment in the fund for at least 10 years, whatever appreciation you get in that fund when it sells is tax-free. There's a big step up in basis. So there's still that benefit. You don't need to use a qualified intermediary, and you don't have the same time requirements you have in a 1031 exchange. So a lot of the folks that look at 1031 exchanges that invest with me, oftentimes they failed their 1031 exchange. So they missed their timelines, their target properties fell out of escrow, there was a skeleton in the closet somewhere, and they decided that it wasn't a good option after all. And so then they take their money and they look at a qualified opportunity zone fund as a backup option, which is fine. Qualified opportunity zone funds are great for people selling stock or selling a business because you can't 1031 exchange those assets. You can use them for art or pretty much any other investment. So oftentimes the qualified opportunity zone is a better vehicle for those types of investments rather than real estate. Also keep in mind that one of the requirements in a qualified opportunity zone fund is that you double your basis in the early stages. So usually you're making a significant amount of improvements, you're taking on debt, and you're doing construction. There's a lot more moving parts. There's a lot more development risk, things like that take place in a qualified opportunity zone fund that our clients need to be aware of relative to our DSTs that are stabilized assets with very little to no moving parts, or tenants in common, which are typically a lot less dynamic as well.
You mentioned how the qualified opportunity zone can almost be like a hedge against someone who tries to do the 1031, but for whatever reason, it doesn't work out. Are there any other types of hedges that you use or kind of strategies you can use for that person that's nervous that would say, well, if I couldn't do a 1031, I wouldn't sell. I don't want to sell my property. But they also don't want to be in the position where they go through the 1031, it falls through, and now they wind up paying the capital gains tax that if they knew that it wasn't going to work, they weren't going to sell the property in the first place.
Yeah, absolutely. Great question. So usually where we hedge against that closing risk is using different identification techniques with the qualified intermediary. So the IRS allows you to use 3 different rules. One is the 3 property rule. That's typically the rule that everyone's most familiar with, where you can identify 3 different properties and you can close on one of them. You can close on all 3 of them, as long as you meet the requirements of purchasing property of equal and greater value within your timelines and so forth. That's the 3 property rule, which you're limited by the number of properties, but not the price. Now you have your 200% rule. In the 200% rule, you're limited by the price of the properties, but not the quantity. So if you sell for $1 million, you can actually identify $2 million worth of property, and the number of properties doesn't matter. It could be 200 different properties, but don't go over the 200% of your sales price, or you end up in the 95% rule. The 95% rule, you have to close on 95% of the value of whatever you identify. That rule is very rarely used. It's usually 3 property rule and the 200% rule. So what we do with these is we have backup options. So our client will come to us with their primary option that they want to close on. Maybe it's a triple net property through our triple net acquisition service. Maybe it's a DSTs, maybe it's tenants in commons, but we will find a DST usually to use as a backup option, whether it's one of the slots in the 3 property rule, maybe the second or third property, or within the 200% rule, we'll find enough equity there to create backup options in case their primary options don't work out. And with a DST is great because the price is already set. The due diligence is complete. Third-party reports are already ordered. And so we know that if the property doesn't work out, we have reservations with the sponsor in the backup DST that they can fall back into in case their primary option gets into trouble, to save them that tax consequence. So that's come in handy quite a bit. But when people use that technique, they have to make sure that they're speaking with us regularly, because their identification could get tricky. So we want to make sure we're working with their CPA, we're working with their qualified intermediary to make sure they're meeting all of their IRS requirements when we're setting up those backup options.
What do you see kind of in the future? Just what's going on in the real estate financial markets now?
Real estate has become very expensive. So a lot of the stories that I've been seeing, a lot of my clients are blue-collar workers, some firefighters, teachers, kind of high upper middle income people that bought real estate over the last 30 years, and it's appreciated tremendously. But kind of your millennials, your Gen X lower, they're kind of getting priced out of real estate almost altogether. It's so expensive. And it's also real estate. It's because that price is getting so high, the cash flow isn't where it used to be either. So they're kind of getting squeezed out and hard to create passive income by owning outright. So I do see fractional ownership as becoming more and more popular. So limited partnerships, LLCs, DSTs, tenants in common, those types of ownership structures are going to become more and more popular to give people access to real estate, but also help them to diversify. So all their eggs aren't in one little submarket, one asset. And if anything happens to that property, then that could be devastating. So fractional ownership is going to help them diversify. So the online platforms like ourselves at RealtyMogul that are more of a real estate private equity focus rather than just a sales platform, I think that might become much more popular and a lot of demand there. As far as artificial intelligence, I know we are using artificial intelligence through our triple net acquisition platform. So we have a strategic partner that pulls in data from a variety of sources so they can look at almost any deal in the market. And they use AI to look at over 1,000 different indicators of the different properties, the different listings and the submarket data. And then at RealtyMogul, we help our clients develop a criteria about the type of property that they're looking for, the length of the lease, the type of tenant, the location. Then we work with our partner to create a search across the country for an asset that meets that criteria. Then the AI creates a hierarchy that actually tiers all the different lists that were provided so that our clients can prioritize their time, looking at the properties that meet their criteria the most at the highest cap rate. And then it provides a price point that we believe that we are highly likely to hit. It may be a little lower than the market price, or it may be higher, but at least it gives us a better idea of where we should come in for a bid on that property and increase the likelihood of us being able to close on that property, which is really important if you're in a 1031 exchange.
Yeah, I can see that definitely helping. Just on something you mentioned about real estate being expensive now. The investor, even on like the RealtyMogul, they can see what the projected cash flow is going to be, because that's a lot of times they look and they'll say, well, if I have this really great interest rate on this property I have because I bought it 10 years ago, and it's tough for them to kind of think about, well, I'm giving that up and I'm going into this other property where the interest rate's a lot higher and the prices haven't come down in correlation with interest rates going up. Now I know interest rates are changing and probably trending downward over a longer period of time, but how does do these deals make sense a lot of times for the investor?
There's two different approaches to that question. The first one is on the actual exchanger and their assets. So I can tell you, for especially investors in California, the majority of time when they look at the market and they see, hey, the cap rates are just too small, they're too compressed, it doesn't make sense for me to sell the property. I'm seeing 5 caps, 4 caps, and I'm getting a lot better on my property now. I hear that a lot. But there's two things that they're not considering. The first is that they're comparing their income based on where they bought it instead of what they can sell it for. They're looking at return on investment instead of return on equity. If they look at the return on equity, they're usually getting 2 caps, 3 caps here in California, especially along the coast here, and they don't even realize it. They're getting 2% on their money a lot of times after you add in property management fees, utilities, vacancies, any kind of deferred maintenance and things like that. And it keeps getting, and the cash flow keeps getting lower and lower the more you add in property taxes. And then when you look at some of the assets that we have on our platform, it might not be what they're used to in 2011, 12, 13, where they're seeing 8% cash on cash returns with big IRRs. But oftentimes, now past performance isn't indicative of future returns, but you're oftentimes able to double the amount of income that they're able to get on their current properties, especially along the coast, even with what looks like lower cash on cash returns than they're used to, because of that using return on equity instead of return on investment. So that's the first thing. The second thing is, with interest rates dropping down, we are finally seeing cap rates above interest rates. So we're getting that positive arbitrage with the mortgages that we're able to get to buy these properties. So in combination with distressed sellers, we're actually able to get some interesting deals. And I think we are at a murky bottom of the commercial real estate industry, where at RealtyMogul, we're able to pick up some really interesting deals that are cash flowing in attractive ways. Maybe not in the first year, maybe we're getting in the 4s or 5% cash on cash. But after that, we're able to really increase revenue by repositioning the assets to get very attractive yields. So I think this is a very good time to be in multifamily, especially since in the last couple of years, we've seen a huge supply of multifamily hit the market, which has brought down prices. However, and it's kind of made rents a little softer. But now it's so expensive to build new product that we're finding properties 20 to 30% below replacement value. To us, that's really indicative of a lot of potential for growth, specifically in the multifamily market. So we're bullish there, and we think it's a good time to get in.
Makes sense. All right, Steve, that's all the questions I have for you today. I want to thank you for joining me on today's episode. Before we finish, where best can listeners get more info, get in touch with you, learn more about you and RealtyMogul?
Yeah, please check us out at www.realtymogul.com. We have a great knowledge center where we have videos and articles that help explain and educate all of our clients and investors. And then you can also email me at Stephen, which is STEPHEN, Haskell, HASKELL at realtymogul.com.
Great. We'll link to all that in the show notes. Thanks again, Steve, and thank you to everyone who tuned in today. Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.